During earnings week, option prices become elevated, and there are a few ways that traders can take advantage of that intelligently by maximizing their profits and minimizing the risk. Of course, let me start by saying this. Buying naked puts and naked calls during earnings week, betting that the stock will go one way or the other, is completely stupid because you are overpaying for options, betting that the stock will go one way or the other. You cannot really predict. Even if you bet that the stock will beat or miss an estimate, that doesn't matter because the stock could move opposite to beats and misses. That happens all the time. Buying naked puts, naked calls during earnings weeks is gambling. It's not investing, it's not trading. But here I will teach you 6 ways where you can trade earnings week and use the elevated option prices to your advantage. Number 1, calendar options. Number 2, buying a different name that is not reporting in the same week, yet under the same sector. Number 3, credit spread. Number 4, gap trades. Number 5, a situation that I call a win-win lose-win trade. And lastly, of course, using covered calls and selling puts if you own or want to own stocks. I will go in details for each of these trades. Please note that the prices showed in this video are as the closing of Friday, July 10th. They're not updated to today, Monday, July 13th. Keep that in mind when I give you the examples. Let's talk about calendar options first. The goal from a calendar call or put is to take advantage of the elevated prices during your stock's earnings week, yet minimize the risk of buying a very expensive option and maximize the potential of revenue by extending the time that you have for the trade to work. For instance, let's take a look at Netflix stock, which will report this Thursday, July 16th. Say you are bearish on Netflix stock. Instead of buying a naked put expiring this week for a very expensive price, why not buy the same put that you're intended to buy, but buy it for next week? And then at the same time, you sell that strike expiring for this week, therefore creating a calendar put. So here's an example from Robinhood using Netflix stock. Let's say that we go to July 17th and we sell the 530 put for $15.80 per option. You multiply these numbers by 100, of course, because each contract has 100 options. And then you buy the July 24th 530 put. Now you've reduced your risk to $3.93 because what you've done is you bought the July 24th 530 put and you paid $19.73, and now you sold the July 17th for this week, the 530, you sold it for $15.18. The difference is $3.93. That's what you paid. You have lowered your risk for the same strike price that you are interested in, yet you got an extension of time for the trade to work. It is a very, very smart trade to make, earnings week or any regular week. Calendar option trades are one of the smartest ways to trade options. Now let's talk about a different situation. Buying different names in the same sector that a stock is reporting in. What does that mean? For example, Delta Airlines is reporting tomorrow in this week, but the options for Delta Airlines are expensive. However, American Airlines is not reporting this week, yet it is in the same sector ETF. Whatever happens to Delta tomorrow will happen to American Airlines. If Delta Airlines beats and the stock rallies, so will American Airlines. If Delta misses or it goes down anyways, even if it beats, then American Airlines will go down the same way. The difference, however, is you get a better bang for your buck buying an option in a stock that is not reporting, yet in the same sector as the stock that is reporting. So here's an example for Delta Airline. These prices as of Friday's July 10th closing. These prices changed today as the market is trading, of course, so keep that in mind. Let's say we are bullish on Delta. We think that the analysts are too grim and Delta will surprise to the upside. So we buy the 28th call. The break even for this trade is the stock has to go over 7.4%. You pay $1.04 for this option. Now let's go to American Airlines. Buy the $12 call for break even of 7.09%. Very similar to the break even of Delta trade. But in this instance, you only pay 69 cents. You're getting a better bang for your buck, and the stock will move exactly as Delta does. So why pay for the expensive option when you can pay for the cheaper one? Let's go number 3, credit options. Again, option prices are elevated. Why not take an advantage and sell out of money calls and puts and collect that cash? Those elevated options work in your advantage. There are ways to do this, of course. You can do what is called an iron condor if you're betting that the price will remain stable after earnings and will not go up significantly or down significantly. You can do an iron condor, and this is an example for Netflix. The iron condor will credit you $8.58 and say the worst case scenario if the stock goes one way or another heavily, up or down, your risk is minimized to $6.42. So you will know what your loss is. Another way, let's say you were bearish on Netflix. You think that Netflix went too high, Netflix would drop after earnings. Instead of buying a naked put and taking that risk, why not use a credit call, for instance? And what you do here, for example, is buy the 600 strike for $9.85. These are all expiring this week for July 17th. And you sell the $5.95 for $10.85 per option, and that would credit you $1. You multiply that by 100, of course, because each contract has 100 options. So you book $100 and you made your credit strike so far out of the money that the probability of the stock, even if it pops, reaching that price is very minimal. You minimized your risk instead of buying a very expensive naked put. The fourth way to trade earnings week is gap trades. Gap trades is simply wait for the stock to report and then make a decision. Usually stocks move big after earnings, up or down, creating what it's known in the charts as a gap. Here's an example from Facebook where I'm pointing for the specific quarter where the stock gapped down after earnings. The idea of gap trades is identifying previous resistance and support levels and buying the stock for a rebound. This is called a gap trade. So you see in this example, the Facebook dropped in the morning after it reported, but it reached a level of former resistance and support. Traders bought the stock and bought call options right at that point in Facebook. And you see that Facebook rebounded for that level, and traders made money on their very short-term day trade. This is for day trading. It's called gap trading. It's very popular among day traders because It is one of the easiest ways of making money fast. You identify former points of resistance and support, and when the stock gaps up or down, you can make trades assuming that the stock will bounce or rebound from that specific level. The fifth way of making money intelligently during earnings week is my personal trademark, what I call a win-win, lose-win trade. I do these trades all the time. I hunt for them, and when I find them, I invest in them heavily. The simple principle in a trade like this is whether the stock goes up, down, or nowhere at all, you still make profits. Sounds too good to be true? Not really. It exists. It is real, and it's what I've been doing for years and years. The simple principle of a win-win, lose-win trade goes as this. You buy a strike, put or call, whatever direction you think the stock is going to go. For example, let's just say that I am bearish on a certain stock. I will buy a strike, pay for it, and then as the stock moves in the direction that I am anticipating, a lower put will increase in price to become worth more than the option strike that I paid for. Therefore, when you sell that strike that is lower than the one you bought for a put option, now you are being paid to trade because you've turned a debt spread into a credit spread at the same time. It's a hybrid of debt and credit spread. You get paid to trade. I know this sounds very complicated, but it's really not. I'll give you an example. These prices as of Friday's July 10th closing, keep that in mind. This is for Netflix. Let's say that I bought the 530 put in Netflix, betting that after Netflix reports earning, it will drop over 6.5%. I bought the 530 put expiring July 17th for $15.80 per option. Now assume that this week Netflix starts moving down heavily before earnings. What am I going to do? I will go ahead and sell the 520 put, but at this point, because earnings are not reported yet, the prices of puts are very elevated. So the 520 strike is now worth 17.18. That is a hypothetical, of course. It could be worth a little less than that. It could be worth a little more than that, depending on how heavily the stock moves to the downside during the week. But in this hypothetical example, let's say that the 520 strike moves to become worth 17.80 per option. You sell that, and now for all intents and purposes, you turn this debt spread into a credit spread because you bought the 530 strike for 15.80, and you sold the 520 strike for 17.80. Effectively, you got paid $2 per option for this trade. That translates to $200 per contract, meaning that you are now paid $200 to trade. You don't have to worry if the stock goes up, goes down, nowhere at all. You're still gonna book that 200 credit no matter what. The beauty of trades like this is you go to sleep like a baby. You don't have to worry about whether the trade goes your way or not. But here's a charting example of how this trade works. If comes Friday, July 17th, Netflix closes anywhere above the strike price of 530, you will collect the $200 and all of your puts, the one that you bought and the one you sold, will expire worthless. Yet you collected $200. If Netflix comes Friday, closes anywhere between 530 and 520, say 525, you'll still collect the 200 plus any amount under 530, but not more than 520. So in the case if the stock closes at 525, you collect the 200 bucks that you get paid for the start, and you collect an additional 500 bucks, and it makes the trade worth 700 bucks. You get paid 700 bucks if the stock closes at 525. Now, say the stock closes below 520, at 520 or below. Your gains are now capped to the 10 bucks between 530 and 520. The difference is 10 bucks. Your earnings are capped to that plus what you got paid to start the trade, the 200 bucks. Meaning that your maximum profit for this trade is 1200 bucks. Because if the stock closes at 520 or below, you're going to have to close that put, the 520 put that you sold, because you don't want the option to get exercised. So let's say the stock closes at 515. Now your 530 put is worth 1500. But remember, you have to pay 500 bucks to close the 520 strike that you sold. So you're capped to that 1000 bucks, of course, plus the 200 bucks that you got paid to start the trade with. I know this might sound a lot for people who are not very experienced with option trading, but that's okay. Replay what I just said, take some notes, and it will become clearer to you. If it is still not clear, let me know in the comments. Send me a message. Say, hey, I'm interested in options, but I don't understand how they work. Can you please make a video explaining? I will make a video explaining to you how to trade options, how options trade in very simple terms. But say this trade is very complicated for you and you want a simpler trade. Here's the sixth and final way that I use to trade earnings week. Say you own 100 shares in any given stock. In this case, we're talking about Netflix, our example. You own 100 shares of Netflix. You think the stock went so high. You want to sell it. You think the stock will report good earnings that will pop. But you're done with the stock. You don't want to have it and own it anymore. Yet you want to make money on your way out. You want to get paid to sell the stock. So what do? You sell covered calls. In this example, for the prices, as of Friday's closing, July 10th, let's say that you think Netflix will pop all the way to 600. Okay, so I'm going to sell the 600 call for $9.83. That translates to 983 bucks. You take that, you put it in your pocket, that's your money. It's done. Okay? Now, if the stock closes at 600 or above, your stocks are going to get called because you sold a covered call. Your 100 shares of Netflix will have to be sold. So you're going to sell them at the strike price of 600. But who cares? You made profit. You bought the stock at 500 or 400 or 300 or whatever price you bought it for. Now you're selling it for a profit and you're getting paid 983 bucks to exit the stock. How nice is that? Now the flip side of that coin, let's say that you're bearish on Netflix. You think that Netflix went too high, Netflix will crash after earning, but you still like the long-term story of Netflix. You want to buy it. You just don't want to buy it right now. It's too expensive. So you're waiting for the stock to drop. Why not get paid while you wait? Get paid to buy the stock. What do you do here? Here's an example for Netflix again. You sell the 540 puts. These prices, of course, as the closing of Friday, July 10th. You sell the 540 put. That's the price that you think is very good entry price for Netflix. You say 540 is good for me. So I'm going to sell that put for 21 bucks. That translates to 2,100 bucks because each contract has 100 options. You take that money, you put it in your pocket, that's your money. It's done. Let's say Netflix goes the way that you want. Netflix drops after earnings and closes at 540 or below. Now you're obligated to buy Netflix stock, 100 shares of Netflix at 540. So your broker is not going to allow you to do this trade, selling the put option, unless you have in your account the amount that 100 shares of Netflix at 540 will trade at, meaning you need to have $54,000 in your account. Because when you sell that put option, yes, you collected the $2,100. That's in your pocket. It's done. But now the stock went below 540 or at 540. You're obligated to buy the stock. So you have to buy 100 shares of Netflix worth $54,000. Again, you got paid to buy the stock. You got paid $2,100 to buy the stock. Isn't that beautiful? Now let's say the trade goes against you and Netflix pops after earnings. It goes to $600. Who cares? Who cares? Because that put that you sold will expire worthless, yet you collected the $2,100. These are 6 reliable ways that I use all the time to trade earnings week. It never failed me. I always made money from it. I always lowered my risk with them. So I might have went a little fast in this video explaining each trade. If anything was not clear to you, ask questions. I'm here to answer, okay? Before I finish this video, I want to reiterate what I said before. Don't buy naked calls, naked puts for earnings week, betting that the stock would go one way or the other. That is gambling. And when the stock goes the other way, the way that you're not betting on, you will lose everything. So don't gamble. Use these 6 ways. I gave you 6 ways to trade earnings week. Use them, lower your risk, maximize your profit, and trade with intelligence. All right, if you like this video, you know the deal. Subscribe, like, share, and follow me on Twitter.